5 crore for retirement, 1 crore for child's education, 1 crore for a house, then weddings, vacations, and medical emergencies. And your salary is 1 to 2 lakhs a month. When you put all these goals into Excel, one of the two things happens. You either shut the laptop or you live with silent financial panic because suddenly everything feels important and you do not know what to protect first. In this video, I'll show you one simple filter that tells you which goals must be protected at all costs, which goals can safely wait, and how to avoid irreversible financial regret. Miss this framework and you won't just make slower progress, you'll make decisions you cannot undo later. Let's fix that now. Why most plans fail? Most plans don't struggle because they earn too little. They struggle because everything feels equally important. There is retirement, then housing, child's education, marriage, vacations, then there is medical corpus, then people try for early financial freedom. So let's take a realistic example. Someone earning 1 lakh rupees a month, their home EMI is going to be 25,000, 15,000 for child education SIP, 10,000 for retirement SIP, 10,000 for lifestyle and travel. On paper, this looks balanced. In real life, it is really fragile. One income shock, one medical emergency, and the entire plan collapses because life doesn't work like Excel. Income is limited, time is limited, and priorities change. So before chasing returns, you need prioritization. And this is where most people get it wrong. So here is the framework that simplifies everything. Stop asking, how do I fund all my goals together? What you should be asking is, which goals are irreversible and which goals are flexible? Irreversible goals have fixed timelines, they cannot be corrected later, and they have no real backup. Whereas flexible goals can be delayed, can be scaled up or down, and they have alternatives. So once you separate goals this way, prioritization becomes logical, not emotional. This one distinction can change your entire financial life. So now let's discuss goal priorities. Retirement. Retirement comes first, not because it is urgent today, but because it is irreversible later. You can take a loan for a house, you can stay on rent, you can downgrade lifestyle, but there is no loan for old age dignity. Many young parents are unknowingly planning to depend on their children. Their entire plan is, Mera beta sambhal lega. My child will take care of me. Trusting your child is fine. Becoming financially dependent on them is not. And that is why retirement SIP is primary funding, even if it is small. Retirement runs first, always. Priority number two is child's education. Child's education usually comes next because the timeline is fixed. If your child is 3 today, college is about 15 years away. That date does not move. Housing can wait, you can adjust your lifestyle, but education support happens at a specific time. And support does not mean 100% funding. You can do partial funding, education loans can be had, then there are options of scholarships, all are valid options. But as the college timeline comes closer, education naturally moves from secondary to primary funding. Priority number three is housing. This is where many people are going to disagree with me, and that is okay. Social media loves the ghar le lo first narrative, buy your own house. Emotionally it feels safe, financially it is one of the most flexible goals. A 70,000 EMI doesn't cost just 70,000. It locks your cash flow for 15-20 years. Now compare that with renting at 35,000 and investing 25,000 every month for retirement. One choice locks your future, the other one keeps it open. Simple question. If tomorrow you don't have enough money, what will you eat? Emotional attachment to your house or actual food? You can always downgrade a rented house. You cannot downgrade old age. And that is what you forget. For most people, housing stays secondary until income stabilizes and retirement is protected. Priority number four is marriage and social goals. Marriage expenses are emotional, but remember, emotions don't pay your retirement bills. By the time children get married, they are usually earning adults and they can also contribute for their own marriage. I have met investors who spent way beyond their capacity on weddings and now they don't have enough. They don't have enough for their own retirement. Those same children are struggling with EMIs, kids, and their own expenses. They cannot support their parents either. This is why I feel that support in marriage expenses should only be provided once you have your retirement funding sorted. Prioritization is not selfish, it's protection against irreversible regret. Next is discretionary goals, vacation and lifestyle. Vacations are not long term financial goals, they are discretionary in nature. And that means flexible timing, flexible budgets, and they're always secondary. You can travel locally, travel less often, and you can upgrade also later whenever you have extra money. So when vacations are funded after core goals are protected, they bring joy. Without that, it is a future regret. So what to do when goals clash? In real life, goals do not arrive one by one. They actually collide. For example, retirement SIPs are running and a house opportunity shows up. Education costs are approaching, but income is still settling. In those moments, you need rules, not emotions. Okay, so what are those rules? Primary versus secondary rules. Think of your money in two buckets. One is primary funding, that is non negotiable, something like retirement SIP, term insurance, health insurance, emergency buffer, and education funding when the timeline is close. These should run no matter what. Secondary funding is what is flexible. So, like a house purchase or house upgrades, vacations, lifestyle upgrades, and then big social functions. Secondary goals matter, but just not right now. And another important thing to remember is sequence beats parallel. Remember this. So, most people try to fund everything in parallel. That is exhausting and ineffective. A better approach is sequencing. So, retirement runs steadily from day one. Education ramps up as deadline approaches. Housing accelerates after income stabilizes. Different goals, different speeds, different real life phases. And whenever two goals clash, ask yourself just one thing. If I do not put money into this right now, can I fix it later? If the answer is yes, it can wait. If the answer is no, it needs protection today. For example, you can delay buying a house and still recover later. You cannot delay retirement savings at 40 and magically fix it at 55. This isn't about chasing the best returns. It is about avoiding decisions that you will regret when it is too late. Protect what cannot be fixed later. If this video made you uncomfortable, that is normal. It means you're thinking long term. In my upcoming videos, I'll show how this prioritization turns into an actual retirement corpus. I'll also cover how to aim for financial freedom even without a huge salary. If you do not want to miss those, please subscribe and turn on notifications. Quick disclaimer, this video is for educational purposes only. Please consult a SEBI registered advisor before taking major financial decisions. Thank you and have a blessed day ahead.